On March 9, 2023, something happened that many people believed belonged to history. A bank run, not during the Great Depression, not during a financial panic from a century ago, not before smartphones, online banking, and instant transfers. A modern bank run. And it happened so quickly that one of the largest banks in the United States went from appearing stable to collapsing in less than 48 hours. The strange part is that Silicon Valley Bank was not a household name. Most Americans had never heard of it. It wasn't a consumer banking giant. It wasn't a famous Wall Street institution. It wasn't constantly appearing in financial headlines. Yet when it failed, the shockwaves spread across the world. Because Silicon Valley Bank wasn't just another bank. It sat at the center of an ecosystem built on startups, venture capital firms, technology companies, and entrepreneurs. And when trust began to disappear, something extraordinary happened. Money started moving. Fast. Faster than many people thought was possible. The question isn't simply why Silicon Valley Bank failed. The more interesting question is this: how can a bank holding billions of dollars collapse in just 2 days? To answer that question, we need to understand something most people never think about. Banks don't operate the way most people assume they do. Many people imagine banks as giant vaults. Customers deposit money. The bank stores it. Then customers withdraw it later. Simple. But modern banking doesn't work that way. When money enters a bank, that money doesn't simply sit there waiting. Banks lend, banks invest, banks purchase assets. The deposits become part of a much larger system. This system works remarkably well most of the time. In fact, it works so well that people rarely think about it. The average person doesn't wake up wondering whether their bank will still exist tomorrow. Trust eliminates the need to ask that question. And trust is one of the most important invisible systems in the entire economy. Trust allows people to hand over their paychecks. Trust allows businesses to keep millions of dollars in accounts. Trust allows transactions to occur without fear. The moment trust weakens, the entire structure begins behaving differently. This is exactly what happened to Silicon Valley Bank. But the story actually began much earlier. To understand the collapse, we need to go back to a period when everything appeared to be going well. During the years following the pandemic, enormous amounts of money flowed into the technology sector. Investors were optimistic. Startups raised capital. Venture funding surged. Technology companies accumulated cash. Much of that cash found its way into Silicon Valley Bank. Deposits grew rapidly, very rapidly. In a short period of time, the bank became significantly larger. At first glance, this looked like success. More deposits, more customers, more growth. But growth can create its own problems. A bank receiving massive amounts of deposits must decide what to do with that money. Simply holding cash generates little return. So banks often invest. Silicon Valley Bank invested heavily in assets that appeared safe. U.S. Treasury securities, government-backed bonds, investments generally considered among the safest in the world, and that decision seemed perfectly reasonable, at least at the time. Then something changed. Interest rates began rising. The Federal Reserve started increasing rates in an effort to combat inflation. Those rate increases affected the value of bonds throughout the financial system. This is one of the less intuitive realities of finance. When interest rates rise, existing bonds often become less attractive. And when bonds become less attractive, their market value declines. Silicon Valley Bank suddenly found itself holding assets worth less than before. Not worthless, not toxic, just worth less. The distinction matters. Because the bank wasn't technically insolvent, it wasn't sitting on fraudulent investments. It wasn't hiding catastrophic losses. It had assets. But it also had a problem: time. And this is where the story becomes fascinating. Most financial crises are not purely about money. They are about timing. If a bank can hold assets long enough, temporary losses may never become permanent. But if the bank is forced to sell those assets quickly, losses become real. Silicon Valley Bank needed time. The market refused to give it any. As venture capital funding slowed, startup companies began spending the cash they had previously deposited. Money started leaving the bank, not all at once. At first, companies needed payroll, operating expenses. Growth became harder, funding became scarcer, withdrawals increased. The bank needed liquidity. Liquidity is another invisible force that quietly shapes the economy. People often focus on wealth, but liquidity is different. Liquidity is access. Liquidity is the ability to obtain cash when needed. A business can appear wealthy and still experience a liquidity problem. A bank can hold billions in assets and still face a liquidity problem. And that is exactly what began happening. As withdrawals increased, Silicon Valley Bank needed more cash. To generate that cash, assets would need to be sold. Selling assets would lock in losses. Those losses would become visible. Visibility creates concern. Concern creates fear. Fear creates movement. The cycle had begun. Then came the announcement. The bank disclosed losses and announced plans to raise additional capital. From a purely financial perspective, this was an attempt to stabilize the situation. But markets are not purely financial. Markets are psychological. And psychology moves faster than accounting. Investors became nervous. Customers became nervous. Venture capital firms became nervous. Conversations began spreading across social media, group chats, emails, and private networks. Something important happened. People stopped asking whether they should withdraw money. They started asking whether they could afford not to. That shift is critical, because bank runs rarely begin when people become convinced a bank will fail. They begin when people become uncertain. Uncertainty changes incentives. Imagine you hear a rumor that a bank might be in trouble. If the rumor is false and you withdraw your money, nothing terrible happens. You can always redeposit it later. But if the rumor is true and you leave your money in place, the consequences could be significant. The rational response becomes withdrawal. Not because everyone believes disaster is coming, but because nobody wants to be the last person remaining if it does. This is one of the most powerful dynamics in economics. Individual decisions that make sense independently can create outcomes nobody wants collectively. As concerns spread, withdrawals accelerated. Then they exploded. Customers attempted to remove more than $40 billion in a single day. 40 billion in one day. Historically, bank runs involved lines outside branches, people waiting anxiously, cash withdrawals, physical panic. The Silicon Valley Bank run looked completely different. No lines, no crowds, no television footage of angry customers outside bank doors, just phones, computers, apps, clicks. The bank run of the future happened through screens. Technology made banking easier. It also made panic faster. Money that once took days to move could now move instantly. Information that once traveled slowly could now spread globally within minutes. Trust was evaporating faster than the system could respond. And trust, once lost, is incredibly difficult to restore. This is the lesson many people missed. Silicon Valley Bank did not fail because money disappeared. It failed because confidence disappeared. The invisible system broke before the visible system did. By the time regulators stepped in, the process was already underway. The bank could not survive the speed of withdrawals. The institution was placed into receivership. One of the largest bank failures in American history was complete. But the story didn't end there, because the collapse raised a larger question. If trust can disappear this quickly, what else depends on it? The answer is uncomfortable. Almost everything. Banking depends on trust. Credit depends on trust. Investing depends on trust. Insurance depends on trust. Currencies depend on trust. Even markets themselves depend on trust. Trust is one of the most important assets in the economy. Yet it rarely appears on balance sheets. You cannot easily measure it. You cannot store it in a vault. You cannot create it overnight. And once damaged, rebuilding it takes time. This is why the Silicon Valley Bank story matters. Not because it was the biggest failure, not because it was the most dramatic, but because it exposed one of the invisible foundations beneath modern finance. People often believe economic systems are held together by money. In reality, they are held together by confidence. Money moves because confidence exists. Credit exists because confidence exists. Markets function because confidence exists. The moment confidence weakens, behavior changes. And behavior changes faster than spreadsheets, faster than forecasts, faster than institutions. This is the invisible economy, the layer beneath the headlines, the forces operating quietly until something reveals them. Most people watched Silicon Valley Bank and saw a failed institution. What they were actually witnessing was a failure of confidence, a breakdown in trust, a reminder that financial systems are not machines. They are human systems, and human systems depend on belief. The next crisis may involve a different institution, a different industry, a different trigger. but the underlying lesson will likely remain the same. When invisible systems weaken, visible systems eventually follow. And among all the invisible systems supporting the modern economy, trust may be the most powerful of them all. Because the moment people stop believing, money begins moving. And once it starts moving, it can move faster than anyone expects.